But at some point, by the end of the year or over the months ahead, we have no idea when this all takes place. We expect that this is going to take place, that the economy is going to begin to look more like recession than not. And the reason is all of these companies that have been hanging in there over the last 8 months or so are going to realize that there is no rebound coming. There actually is no soft landing. This actually is a dangerous economic environment. And so they're going to begin the layoffs, which then trigger all the recessionary second and third order effects.
On today's episode of the WTFinance podcast, I have the pleasure of welcoming back Jeff Snider, one of the foremost experts in the monetary system, host of the Eurodollar University, which is a great podcast as well as YouTube channel, and is also Chief Strategist at Atlas Financial. So, Jeff, thanks for coming back on the podcast.
Hi, Anthony. Great to be back.
No problem. And I think last time we talked a lot about Eurodollar and there's a bit of an introductory video. So I'd recommend anyone, if they want to learn more about that, maybe watch that video. And I think today we'll look at more about maybe implementing it and understanding, okay, maybe we sort of understand what the Eurodollar system is because it's very complex and it takes a long time to understand. But then from there, how is that actually going to the real world and what does that mean for what we're seeing today? So yeah, I guess from your perspective, if we look at the start of 2022, none of us probably could have guessed that we'd be at 5% Fed fund rate and that the whole world wouldn't have imploded. The whole finance system would still be here. And there's actually even talk about potentially a soft landing and the Fed of recovering this. So I'm not sure from your perspective, why do you think the markets haven't reacted maybe as we thought, most markets? And then from there, what do you think this means for the economy going forward?
Well, what's really driving interest rates, to start there, isn't just as you said, Anthony, it's the Federal Reserve, it's the rate hikes. And so beginning 2022, the Federal Reserve had said, well, we're not really sure about this consumer price stuff. We thought it was transitory, but we're getting all these phone calls from the White House and Congress saying, do something, do something, do something. So all of a sudden, the Fed has political pressure, and we all know that they claim independence, but they're not really independent. So beginning 2022, the Fed was transitioning from this is no big deal to holy cow, our bosses are telling us to do something. And the market was having trouble deciding, where is this going to go? And that was really, that's the big point here, because that was the only thing that changed in the interest rate markets in 2022. It wasn't consumer prices, it wasn't inflation, it was how the Fed responded to consumer prices for non-economic reasons. So that's why the market seemingly was caught off guard by these rapid rate hikes, because nobody knew they were coming. Because the market position was this was never inflation to begin with. And that's really the starting point when you talk about starting from the Eurodollar perspective. This was always nothing more than a transitory supply shock. So had the Fed had done nothing, just sat and done nothing, if that was an option, interest rates wouldn't have gone anywhere. Even as consumer prices rose, the market was always expecting those to be temporary. And that's what we saw over the second half of 2022, was that even as the Fed continued to hike rates, consumer price pressures were already starting to come down, even really before the Fed got going, which gives us, the sense of where the market is trying to price long run. What does this actually mean in the economy versus short run? How is the Fed going to react to each and every data point along the way? Because they're more concerned about what's driving the current CPI rather than focus on what actually drives consumer prices in the real economy. And that leaves us at the end of 2022 with the yield curve wildly inverted, because at the short end, they got the Fed doing its non-economic stuff. And at the long end, you've got nothing really changed. We're still in the same temporary supply shock that we had from before.
Yeah. And what does that, I guess, inverted yield curve mean for the monetary market or for the money markets?
Well, technically speaking, what it means is that short-term rates are much higher than long-term rates, which is a condition you never want to see in any money or finance curve, because money and finance, any curve should be upward sloping, not steeply, but gently upward sloping, which represents the natural equilibrium, for lack of a better term, of how money and finance is supposed to work. Because think about it this way. If you're going to lend somebody money for 2 years, you're going to want some level of return. But if you want to lend them, if they want to borrow from you for 3 or 4 or 5 years, you might need a little bit of extra yield in order to lend for a longer period of time. So given completely benign conditions everywhere else, what we should see is that gently upward sloping to the yield curve, not steeply, because the amount of premium demand to lend for a longer period of time in a good environment shouldn't be all that much because risks are relatively low. But when the yield curve flattens out or inverts where shorter term rates are higher than longer term rates, immediately that tells you, okay, something big is wrong here because it's way outside of what a normal curve shape should be. And taken literally, what it means is the market expects that interest rates over time are going to be lower than they are in the short run. And then it's incumbent upon us to figure out why that might be. And there really aren't all that many scenarios that would produce an inversion, let alone this level of inversion, because they're usually nothing good. What is it that usually leads to lower interest rates in the future? Well, the list there is usually recession, nasty recession with a financial crisis. I mean, there really aren't a whole lot of good scenarios, which is why people always pay attention to the yield curve only when it inverts, because it usually is tied closely to a recession or something like that. So the market began actually 2022, going back then. One market in particular, Eurodollar futures, had already inverted at that early stage. And then the yield curve inverted in March, and then the inversion got heavier. So to all of these curves, by the end of 2022, the inversions were absolutely gigantic, which meant that market participants were hedging in a way that would pay off when interest rates go lower for a variety of reasons, a variety of fears about what the intermediate term might look like.
And I guess, where do you think this will go? Because you would assume that it can't remain inverted forever. How does this go to the recession? Is that sort of your, I guess, your base case that you're thinking will occur?
That's generally what markets are pricing. They're pricing that at some point, and they've been pricing this all along. So again, that's the difficulty in figuring everything out, is when does the interest rate regime stop rising in the short end? What does the Fed stop hiking rates and get with the real economic fundamentals and start reducing them? Because as John Maynard Keynes said, paraphrasing, the Fed can stay irrational longer than you think they can. So the Fed can continue hiking rates based on an economy that doesn't exist, but at some point reality has to intrude. And as far as the market goes, that reality hasn't changed throughout. It's an ugly one, because supply shocks, where you see consumer prices go up for non-monetary reasons, but for imbalance in supply and demand, historically speaking, they always end in recession. So from the very start, all the way back in 2021 into 2022, markets have been expecting recession regardless of what the Fed does. And the only variable along the way has been, when will the Fed stop hiking rates and when will they start cutting rates? And that remains the case now, even though a lot of people have become more optimistic. The soft landing scenario, or now some people are calling it no landing. The economy is just going to zoom right on through. There wasn't even a slowdown. Not according to the marketplace. The marketplace, what the markets are saying is that you don't see a recession in the current data, but it's there when you look at it, and you will start to see it more clearly over the months ahead.
And what other data points are you looking at in that regard that you think there'll be a recession? Is it mainly the inverted yield curve? Is there anything else that you're seeing?
No, there's lots of macroeconomic data. I mean, the market data is pretty clear. The curves are pretty clear about where this will all go over the intermediate term. But even some of the macroeconomic data is, relatively speaking, very much it's very much in the same shape as you would expect, either before or in the early stages of recession. I'm thinking about things like the household survey of employment. Everybody focuses on either the unemployment rate, which is at a 50-plus year low, or the establishment survey payrolls, which in January was this epic 500,000 increase. Well, you look at the household survey, which is the one nobody looks at, even though that's where the unemployment rate actually comes from. The household survey has been flat to slightly higher ever since last March. So we're talking about an 8-month period with almost no employment gains. It contrasts very sharply with the establishment survey, and the level of full-time jobs in the household survey, which is a crucial cyclical indicator, has been flat to lower since last March, which happens before every modern recession. We saw this in 2007. We saw the same thing in 2000. because companies don't want to lay off workers unless they absolutely have to. But when faced with material weakness, what they will do is they will stop hiring workers and they will cut back the hours of some of the workers that they have. So if you look at full-time jobs, it went like this and then like this, like every recession. So there's that. There's some other measures like industrial production. Obviously, there's an inventory component going along with here. Many companies, especially in the United States, confused the CPI for actual legitimate recovery and ordered way too many goods over the last couple of years. And as demand softened, now we have an inventory cycle to work with. The Fed's IP data, again, the same thing. You see a expansion, and then it doesn't go immediately into contraction. There's this period where it goes sideways for a while and starts to roll over. Over the last couple of months of 22, we've seen that roll over. Another one is real personal income, excluding transfer receipts, which is what the BEA measures as private income, how the private economy is generating income and through employment. And that one's probably the most concerning of all, because that too is flat for the last couple of years. When income should be rising rapidly, if we're in the labor shortage, low unemployment rate paradigm that those other numbers suggest. So you don't have enough income from the private economy. So of course, demand's going to be soft. So you see the inventory cycle, you see labor numbers, some of the labor numbers roll over. So there is a catalog of macroeconomic data that is consistent with recession. It's just not uniform throughout everything.
And I guess that's why it's always challenging to predict the time of when these recessions will occur.
Yeah, and that's, there is no rule of thumb here. I know that people, they talk about the technical recession, which the US actually had in the first half of last year. That's not a recession. I mean, 2 straight quarters of GDP. You can see any number of examples. The most famous one or most prominent one, maybe people don't know this, was the dot-com recession in 2001. It was not 2 consecutive quarters of negative GDP. It was actually a down quarter, an up quarter, and then a down quarter, and that was an actual recession. So every recession looks differently, and you're right. Especially in the initial stages, it's a gray area where some things look good, some things look bad, and a lot of stuff is in the middle. And so it's almost like a Rorschach test. You can look at the good stuff and say, the economy is holding up really well, which is the position that policymakers always take. I spend a lot of time going back in historical transcripts of the FOMC, and they have the same stupid discussion every time. Some of the data looks weak. Some of the data looks good, and they pick the data that looks good and say everything is fine. And that's why it's so important to look at what the market is thinking, because the market is inside the real economy, telling you what it perceives about the real economy, so that we can look at this gray area of some good data and some bad data and say, well, the reason some good and some bad, the market is already telling us, is because it's transitioning from all good to all bad, but we're in the middle part of that transitionary period where only some is good and some is bad.
Yeah, you're a brave man reading through all the FOMC letters. I don't know how you've done it. You released a video recently, which was talking about, I guess, China and how it hasn't really had that reopening that we've expected, and that could be another.
Today.
Yeah. And what happened today?
Today, last night, the Chinese, they issued they released their PMIs for manufacturing, non-manufacturing for February. I mean, the manufacturing PMI was the highest in the decade, but it was only 52.6, which highest in the decade makes it sound like, oh, reopening's going really well. But you have to keep in mind what these PMIs are telling us. They're only telling us about relative changes. So if you're in a major downturn and you start to come out of that downturn, you would expect the PMI to turn modestly positive. But that's all it tells you, is that the downturn is likely ended. It doesn't tell you anything about how fast you're coming out of it, but it's the highest in a decade. So China must be booming. But that's, Matthew, that's consistent with this type of stuff that goes on, is that you look at some of the data and you really have to be careful in how you interpret it, because it's not always as straightforward as it's made to seem.
Yeah, because I know before you were talking about a lot of these manufacturers are really struggling. They're not getting any orders at all. There's all these cargo ships. There's just not that demand for the exports to, I guess, other countries. Do you think that's still going to be an issue going forward?
Yeah, I think, it has been so far. And so the question is, what would change? The the political change in China, the elimination of zero COVID, the removal of pandemic restrictions by itself, not going to do anything for external demand, at least not in the immediate term. I mean, you could argue that a reopened China eventually will lead to more demand for resources and raw materials if the Chinese start to build stuff again like they used to. But that's down the road if that happens at all. But the recent numbers I mean, the Baltic Dry fell to almost a record low just recently. Then it rebounded again, which short run everything happens. Which, if the PMIs were as they're being interpreted as the highest in a decade, how could that possibly be? Because Chinese factories are supposedly humming in a way that they haven't in a decade. So they would be ordering iron ore and coal in massive quantities, which you would see in the Baltic Dry Index, which hasn't happened. Container rates. If there was tremendous demand for Chinese products, then we would expect, even if China was closed, container rates would be rebounding because demand for when China opened would be there. Instead, what we see is there are tons of container ships waiting in China to be loaded, and they're still waiting. Container rates continue to fall. So even if the PMI suggests that reopening or that China is coming, the bottom has been reached in its recent trough, that doesn't necessarily mean that the Chinese economy is about to grow and recover robustly. It just means that maybe the worst is behind them, and that doesn't mean it's better anywhere else. So PMIs notwithstanding, up until now, it's been, where is this reopening? And it's really, I think that's backwards. It's really the global economy, in particular, the global goods cycle, is already in recession. That's one place where you really do see recession very clearly is in global trade numbers. So global trade recession already happening, which means an external drag on China at the very least, but also China is a reflection of that lack of global demand.
And is that trade cycle? It's obviously quite cyclical. So there'll be times where there's very high demand, I'm sure, during COVID, where, I guess the sort of freight costs were ridiculous, or the maritime costs were ridiculous. And now we're seeing the opposite. Is that sort of how it normally goes?
No, I mean, yeah, this is extraordinary circumstances because, container rates in particular, the most prominent example of why this was always a supply shock and not inflation was the container rates on the route from China or East Asia to the US West Coast, because the US West Coast was the most jammed up, ridiculously slowed and constrained port facility, a couple port facilities in anywhere in the world. And of course, that's where most of the US trade with China comes from anyway. And so you saw container rates that were normally around $1,500 per standard unit get up to around 20,000 per container. It's not because demand was so strong. It was because, number one, companies did over order for inventory, just trying to hope something got through that logistical nightmare. But really, it was about lack of containers, because the way the process played out, it took so long to unload fully loaded fully loaded container ships loaded with Chinese goods at the U.S. that ships weren't waiting to get reloaded with empty containers to take them back to China. They all just stacked up in Los Angeles. So the price of containers was reflecting of the supply imbalance, not the economic fundamentals. So eventually, as this logistical problem worked itself out over time, usually with falling demand, which makes it easier to work through these imbalances, that prices would come down. But we didn't expect them to come down so much. We didn't expect, because there are still logistical problems. And now container rates are now the lowest they've been in since 2020. Does that mean that the economy is normalized, everything's good? Or is that a reflection of the fact that we still have supply problems and there's really a lack of demand? And that's what we're seeing in a lot of not just container rates, but all these trade statistics and market prices, which suggest that demand has fallen more than supply has normalized.
Yeah, which is scary to think. So if we look at, let's assume that this, everything we're seeing points to a recession. What would that mean for the financial system? I guess the monetary system. Does that change anything that will occur there?
It's potentially a problem depending upon how it plays out and depending upon a number of factors of how the market reacts. I mean, I talk about all the time when it comes to the monetary system, the collateral problem, scarcity of safe assets, which I know most people are like, what do you mean there's not enough treasuries. There's got to be too much. The U.S. federal government is the most broke institution, a spendthrift in human history, and that's true. But the monetary system depends upon highly liquid collateral, which is what the U.S. federal government supplies, along with other sovereign governments like Germany or Japan and some other places around the world. But there really isn't enough US dollar denominated safe assets, liquid assets, to supply the entire needs of the monetary system. And what ends up happening in any sort of downturn, recession scenario is, in the absence of the supply of safe assets, a lot of bad assets have been used. A lot of junk assets have been used in their place. Many people rationalizing that as, well, this is a crappy quality financial instrument, but the economy looks really good. Look at the CPI in 2021. It's booming. The economy is great. So even though this is a junk bond, I'll accept it as collateral at a high face value because everything looks fine. But then the economy starts to not look fine. And you look at that junk bond and you say, well, now I'm a little bit worried about it. So I'm going to cut back on the valuation I give, which acts as a margin call of sorts, meaning you got to find better quality collateral or more of junk quality collateral, which I really don't want, which leads to this collateral squeeze, which we see as a potential monetary bottleneck, which, if you really had to distill the 2008 crisis into a single factor, which you shouldn't do, but if you were going to do that, the single biggest problem was a collateral shortage. So that's always in the background. That's always an issue. And in fact, I think that was the biggest issue in the monetary system in 2022 for various reasons, not the Fed. So we had a collateral problem already that got really bad and got really close to crisis proportions around September and early October. And then it's calmed back down again. So you have to wonder, if we go into a recession, especially if the recession ends up being either severe or prolonged, do we get that kind of monetary bottleneck? Does that come up again as we fall into recession? I mean, that's the real risk there. And there's some other ones too. A lot of banks are balance sheet constrained to begin with. So that makes it difficult to engage in ongoing finance. And so, yeah, in very brief general terms, recession can lead to financial and monetary difficulties, which of course then just make the recession worse, which make the financial difficulties worse, and you end up in this self-reinforcing problem.
And if I'm not mistaken, most of this comes from, I guess, the Eurodollar markets, where all the offshore creation of US dollars and US debt. Is that correct? That's where a lot of the collateral comes from? Or is it more treasuries and bills?
The collateral comes from the U.S. government, but where it gets used and how it gets used is in this offshore shadow money space. And that's really where we have very little information. That's why I call it shadow money, is that we don't really know. So, I mean, what we do is we look at financial numbers that we can see, or statistics that we can see. A couple of big ones are like treasury bill prices, treasury bill yields compared to certain monetary equivalents tell us something about the extra premium that's being demanded for the best quality collateral. And from that, we can infer a collateral shortage. We also see some statistics like repo fails or use of the Federal Reserve securities lending window. Those have gotten much better than they were in last September and October. So that's good, but they haven't actually normalized. We're sort of in between that extreme and what we would consider normal. So still elevated risk, still elevated scarcity. That's certainly there to begin with. And that's really what we can see. So yeah, we are inferring from these numbers what we think is a reasonable approximation of what must be going on in the collateral system. But as you said, Anthony, it's offshore. We don't really have any direct window into it, but we can see what happens in the markets. We can see how it impacts other financial markets and monetary characteristics too.
And that could almost be where the most risk is, because as we said, a lot of the banks are sort of supported by the Fed and they have that facility, but a lot of these shadow banks don't have any access to any of that liquidity or that facility at all. So it could be where the risk is.
There's always that risk of fragmentation, which is another big problem that happened in 2008. We think of the monetary system as a monetary system, a monolithic whole. And the Fed wants you to believe that it's a monolithic whole with it at the center, when in fact, there's actually various pieces of a monetary system. And in 2007 and 2008, and repeatedly again in discrete periods ever since then, some of these parts will break down. And if it's a severe enough breakdown, it spills over into other parts. And so you have malfunctions all over the place, and the Fed is really powerless to do much about it. And as you said, some of the big banks, we're not going to see another Lehman Brothers. We're not going to see another Bear Stearns. The big type of failures that we saw a generation ago, we're probably not going to see them for quite some time. But that doesn't mean that we're not experiencing massive monetary problems. I mean, you could just think, I just talked about this recently. Instead of big banks that are failing like they did 15 years ago, we've got countries that are failing. We had Lebanon, we had Sri Lanka, we've got Pakistan right now, which is a scary proposition. You think about a country of 220 million people that is nuclear armed and has a long-standing border dispute with another nuclear armed power in India. So instead of Bear Stearns failing, what if Pakistan fails? That's an ever-present risk that the monetary system might be dealing with or perceiving that maybe you or I don't actually do it or don't actually see it. Certainly for watching the U.S. unemployment rate and trying to get a sense of risk from only that. So there are any number of ways in which the monetary system can fracture and fragment that lead to much bigger problems than just the individual parts.
Yeah, so is that linked to sort of like, as you said, there's collateral shortages, but also I guess dollar shortages in certain parts of the world?
Yeah, the collateral shortage are often related to dollar shortage, but it's not exclusive. So you could have a dollar shortage problem that has nothing to do with collateral. In the case of Pakistan, which is a really good example, and to a certain extent, India to the same to a certain degree, what happened during 2021 and 2022 was not a booming global economy. It was a monstrous redistribution. So if you were a country like Pakistan, India, or Japan, and to a certain extent, China, if you were a country that imported your basic needs, which were food and oil, and the prices of food and oil go through the roof, what happens? It becomes an enormous burden upon your system because you don't make your own food, you don't grow your own food, you don't mine and produce your own oil. You got to buy it on global markets, and supply constraints have limited supplies. You're left paying a lot of money, paying a lot more in US dollars than you have available. And if the global dollar system was expanding rapidly, then there would be a number of banks and financial firms falling all over themselves to lend money to Pakistan and Sri Lanka and saying, the economy is really booming. Sri Lanka's at no risk. Pakistan's at no risk. We're going to lend them all the dollars they need to pay for their funding shortfall so they can pay higher prices for food and oil. But that never happened. The monetary system said, this is a nightmare. This is bad. This is going to lead to a bunch of bad things. So Sri Lanka, you're on your own there. I'm not going to lend you dollars. And so what Sri Lanka did was it had to go into its reserves, its US dollar reserves, and sell off its US Treasuries and whatever else it had to the point that it almost ran out of reserves and couldn't pay for any imports whatsoever. Pakistan was in a very similar situation just a couple weeks ago. Pakistan's national US dollar reserves got to less than 3 billion. That was about 17 days of worth of money to pay for oil and energy and food in a country of 220 million. That's how bad it was. And the only banks that were willing to step in and lend dollars over the last couple of years were China Development Bank and China's Export-Import Bank. But the Chinese have their own problems. And what changed over the last 6 months of last year was the Chinese said, we're not going to lend you any dollars either. So now that you have these major countries exhausting their reserves and the prices of these imports, because they're non-economically set, continue to be exorbitant, they're in serious trouble. And nobody wants to lend dollars to these countries, which has left them on the brink of disaster. I mean, the Pakistani defense minister got on TV and said, we're already bankrupt, which is, I mean, it's just, that's how serious the situation has become. So while everybody sits back and says, well, the Fed's got this handled, there hasn't been a Lehman Brothers, we're looking at Pakistan going bankrupt and not being able to buy food and energy. That's something that would concern me as a global market participant.
Yeah, it's very scary. And I guess if we look back at 2020, what we saw in the markets was actually people wouldn't even buy collateral. They wouldn't even buy, bills or bonds. There was sort of no market for it. People just wanted dollars, dollars, dollars. It was all sales. So do you see something like that happening in the future, or do you think maybe the Fed? Because I think during that period they actually came in and basically bought up every single treasury or bond available. Do you think that would be the case?
Well, the Fed wants you to think that's the case, and they want you to think that was the case, but it really wasn't. In what you There's a lot of stuff that went on in March of 2020, and part of it is exactly what you just said, that foreign reserve managers faced with a dollar crisis, which meant that these global banks, these global Eurodollar banks, were not willing to lend to almost any country around the world, and not really the countries, but to the banks operating in those countries, who then lend dollars to companies who then buy stuff on the global marketplace. So it's really bank to bank. And where countries and central banks step in is when their local banks don't have dollars. They're like, what else can we do? We need to buy stuff in the global marketplace. And so the national central banks and reserve managers say, we'll help you out here. We'll sell some of our reserves. And usually that's used to subsidize local bank borrowing on dollar markets. And sometimes that works, most times it doesn't. In March of 2020, because everybody was doing this at the same time, and what they were trying to sell out of the reserves were off the run illiquid treasuries. Not all treasuries are actually liquid, only certain classes are. That when everybody began to sell these illiquid class of treasuries, it started to look like the mortgage market in 2008. So the Fed said, well, we got to rescue the treasury market, when that was the wrong diagnosis. The problem wasn't the treasury market. The problem was the dollar crisis and the dollar shortage that led to all the selling in the first place. So the Fed came in with its monster QE and said, we're going to buy up these illiquid treasuries because we think that's the problem, when that was only the symptom of the larger problem. So if we get into the same situation, and I'm leaving a bunch of stuff out here just to simplify a little bit. So if we get into the same situation at some point in the future, it would have to be widespread. It wouldn't just be one country or another. If there was a generalized dollar problem, where a lot of countries are selling their illiquid US Treasury reserves, it could cause enormous problems. Even though the Fed has established something called FEMA, which is set up to actually buy these illiquid treasuries, these off the run treasuries, so far it hasn't really seen any activity, and I don't think it will. But there's the risk that it becomes a problem, and there's the potential that it won't be as bad as 2020, because some reserve managers could appeal to the Fed's various rescue programs, for lack of a better term. But there are still deficiencies. There are still faults in the monetary system. The biggest one is always collateral. And it's not just collateral for repo, it's also collateral for this massive currency market, which is really mostly derivatives that nobody understands, that nobody has any idea how many there actually are. And that's really where the dollar shortage comes from, which collateral is a part of, is in this even bigger shadow component of currency derivatives, which, how is the Fed going to bail out the currency derivative market? They're not. I mean, that's not even on their radar.
Yeah, so if we look at, last time we talked about how the Fed doesn't print money, and they sort of share these sort of central bank notes, or sort of reserves, sorry. So how is this money created, other than, so if these sort of shadow banks stop lending, or these Eurodollar banks stop actually lending, is there any other way that they have to create dollars?
No, that's where the money comes from. See, I think that's the biggest misconception about what the Eurodollar system actually is, and the biggest misconception about what money is. When you ask people what money is, they think it's this piece of paper that has all this government scribbling on it, and that's what money is. I mean, in a sense, that can be money, but in the modern age, really going back to the beginning of the 20th century, hand-to-hand currency was a very small part of commerce and finance even less. What money is a nothing more than what it's a ledger system. So money is whatever the ledger keepers say it is, and the ledger keepers are these banks. When you ask people what a bank is, they think it's a warehouse of actual money. They think it's a building that has this vault in it, and there's a bunch of cash. And it might not be a vault; it might just be an ATM machine, and that's what a bank is. And that hasn't been a bank in 100 years. Banks are nothing more than bookkeepers. They're record keepers. So when you're the record keeper, you can create money out of thin air. You just write it down. As long as there's an asset and a liability, double accounting, You've just created money through the extension of credit. And I think people are familiar with that process when they think about fractional reserve lending. That's really all it is here, with some important complications and twists. So because there's no physical currency, it has nothing to do with the government or the Federal Reserve, because it's all about what these banks keep down in their ledgers. And if the banks aren't creating more money through expansion of their ledgers, and there's reasons why that's the case, then what happens? Well, the Fed tries to stuff its bank reserves, but the Fed bank reserves are nothing more than one kind of asset for these global banks. And if the global banks say, well, thanks for these bank reserves, I'm not going to change what I'm doing, it does absolutely nothing. The Fed can create trillions of dollars in bank reserves and call it money, but it doesn't hit the real economy in any place. So if the banking system takes in bank reserves, but doesn't use its own resources to do something in the real economy in response to those bank reserves, no money is created as far as the real economy is concerned. In fact, all that's happened is the Fed has rejiggered the asset composition of balance sheets inside that banking system. Everything is about what the commercial banks in the Eurodollar system do, not central banks. At most, the central banks hope to influence the behavior of banks by, I don't know, some kind of psychological Jedi mind trick or something. If I'm doing QE, then look at the markets will be better, so you'll be less worried about perceptions, and therefore you'll extend credit. I mean, it's really not a straightforward process at all, and there's really no money printing from central banks. It all comes from the mechanics of balance sheet activities.
And that's the risk of a recession, where the longer this occurs, the less, I guess, loans or dollars that are being created, and the more potential for this shortage to occur.
That's what really governs money creation. It's risk aversion or risk taking. When you're in the mood to think, if you're a banker, you think, well, I've got a certain amount of capital. I've got to manage liquidity risk. We have to manage the various funding options that you're using, whether it's depository, traditional stuff, whether it's wholesale, rollover risk, whatever the case may be. You've got a number of risks to worry about, and then you've got to look at the opportunities in the marketplace. And if the opportunities are perceived to be not really great, and the risks are perceived to be pretty substantial, it doesn't matter what the Fed does. You're going to say, I'd rather just own a bunch of safe assets because the opportunity isn't great. And so the risk adjusted return is really low. There's really no reason for me to expand my activities. I'm just going to pocket some spreads off of some treasuries and wait for things to get better, assuming they ever do. So in that sense, it makes sense. If you're risk averse, you're only going to stick to safe, liquid opportunities, which is why treasuries and sovereign bonds are always the preferred investment, at least for the last 15 years, because nothing has changed in that regard. So to get to a monetary creation situation, you've got to get the money creators to become risk takers. As Keynes said, animal spirits. That's really what it is. But you can't fake it. You can't say to a bank, well, just trust me. Everything will be fine, because the banks know that kind of trust is garbage. It doesn't work. We saw what happened in 2008. You guys said trust us back then, and it was a nightmare. So it has to be a legitimate prosperity, legitimate opportunities down the road that make up for the substantial risk. I have to be assured that the return is worth it to take the risk, because the risks are considerable in other factors.
Yeah, it's really interesting. So I guess this might be a bit of a loaded question, but if we look at 2023, what is your outlook for the year?
The outlook is uncertain. I say that. No, I say that's actually a joke, because what did we hear from all of these companies as they were laying off workers at the end of 22 and the start of this year? They said, we don't want to do this because we're doing it because the economy looks so uncertain. What they really meant to say was, no, the economy is not uncertain. We're seeing a softening in demand. We're seeing our activity and revenue prospects today under pressure. And we expect that that's going to continue, which is why we're getting rid of some of our workers, because we're anticipating lower revenues and lower business in the future. So I would expect that 2023 would be as similarly uncertain as a start, if not a heightened degree of uncertainty, which I don't know if you saw the ISM report today, the manufacturing report, one of the comments that was in the press release talked about how respondents to the ISM survey were saying, we're still holding a line on our head counts. We're not firing workers because even though demand has softened, we expect a second half rebound. And so that's really what this year looks like. All these businesses across the economy, not just the United States, around the world, are hanging in there. They, as I said before, they might have instituted hiring freezes. They might be cutting back the hours of some of the workers, which is why full-time employment looks like it does. But they're not mass layoffs. There's not the kind of layoffs that we would associate with recession, because a lot of businesses are saying, yes, the economy is uncertain, meaning soft, but we expect things to get better down the road. And so what I expect of 2023 and what the markets expect, these inversions of 2023, is that the second half rebound doesn't show up. And if the second half rebound doesn't show up, then all of these companies that have been waiting for the second half rebound say, oh, the second half rebound isn't coming. I better start firing my workers. So that's when the layoffs happen. So what we expect, what the markets are telling us, is that at some point this year, and it's not going to be it's not going to be a uniform process. It's going to be a messy process. But at some point by the end of the year or over the months ahead, we have no idea when this all takes place. We expect that this is going to take place, that the economy is going to begin to look more like recession than not. And the reason is all of these companies that have been hanging in there over the last 8 months or so are going to realize that there is no rebound coming. There actually is no soft landing. This actually is a dangerous economic environment. And so they're going to begin the layoffs, which then trigger all the recessionary second and third order effects.
Yeah, it's really interesting. I guess from that perspective, what do you think that would mean for the markets if we compare it to previous times that's happened?
Now, if you're talking about stock markets, I think that what usually happens is the stock market, the bond market's a different story, obviously. The stock market gets really happy at the first, because what the stock market, especially this stock market, says is that, oh, hooray, the Fed's going to stop hiking rates, and that's going to be great. And then the Fed will start cutting rates, and the market will go, hooray, the Fed is giving us what we want. We want rate cuts. And then at some point, the stock market will say, oh, that's why the Fed's cutting rates. That's not a good thing. And then shares go down. So you could have a situation like 2007 where the stock market reaches record highs, even after the crisis has gotten to be fully in bloom. We had a record high in the S&P 500 and Dow Jones in October of 2007, just weeks before the Great Recession actually officially began, and when it actually had already begun before then. The global monetary crisis of 2008 was already 2 months old, and stocks were at a record high, until everybody realized that probably wasn't a good thing, that the Fed was cutting interest rates. And then even then, in the early part of 2008, the stock market rebounded in the middle of 2008 because everybody said, look, those geniuses at the Fed, they've done it. Bear Stearns will be the worst part of the crisis. We're now into recovery. We expect the second half of 2008 to be a second half rebound, except it wasn't. It was a second half nightmare. So stocks even rebounded and recovered most of their losses in 2008 in the middle of the Great Recession. So share prices, if we call the economy uncertain, let's call the stock market volatile.
Yeah, I think that's a great message. So, Jeff, thanks again for your time today. I really appreciate it. So, my last question is, what is one message you'd like people to take away from our conversation?
I think the main takeaway is to just be skeptical and ask questions. What I tell people all the time about the Eurodollar system is, do not take my word for it. You can if you wish, but there's a wealth of information and history and documentation out there. Just look at the evidence and evaluate it for yourself, because mainstream media, mainstream sources, there's not a lot of insight into any of it, which leaves a lot of people confused about what's going on and what's happening. Certainly do not take the word of central bankers, who are always incentivized to give you one particular set of circumstances and forecasts, which make them look good and look the best. So if a central banker is telling you that we're gonna hit a soft landing in a Goldilocks scenario, you should take that with a mountain of salt. So if anything, you just always be skeptical, evaluate the evidence for yourself.
Yeah, people are hanging on their words, never going to tell you the truth, because they're always going to do whatever they can to remain as
That's
popular as
assuming they
possible.
even know the truth, which is an assumption you probably shouldn't make.
Yeah, that's a good point. So, Jeff, thanks again. So, we mentioned your YouTube channel. Would that be the best place for people to find your work? Is there anywhere else?
You can check the YouTube channel is Eurodollar University, or our website, which is eurodollar.university, just to make it easy.
Awesome. I'll put that on the description below. So, thanks again.
All right. Thanks, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.